Hi, this is Mr. Evans. This video is going to look at a potential question on investment appraisal. Investment appraisal is a question that AQA on the last specification had a track record of asking questions on, and it appears in the new specification as well. So maybe they will ask a question on it this year. So I've prepared a little case study based on some of the past AQA ways they've asked investment appraisal questions, and this might be a useful video for you so you can practice answering such a question. The question is, would you recommend that Rena approves Tom's proposal? Give reasons for your answer. Now this could be a 16, a 20, unlikely to be a 25-mark question because those questions tend to be focused on all businesses, but let's just say this is a 20-mark question. And let's have a look at it. So we know it's going to help us read the case study if we know what the question is. And the question is, should Rena approve Tom's proposal? So Coffee Vendors is a company that installs and supplies coffee vending machines in offices, schools and at petrol stations. They were the first coffee vending machine company to sell fair trade coffee, and their ethical brand image is part of their USP. However, sales have been declining for a number of years as many consumers have switched to purchasing better quality coffee from the growing number of coffee shop chains. Marketing Director Tom has been investigating the market for disposable coffee cups, which are manufactured from a combination of paper and coated in plastic to make them waterproof. He believes that this would allow Coffee Vendors Limited to sell to the big coffee shop chains and so benefit from the growth in this market. Tom has investigated the costs and revenues to be earned from enlarging the current factory to produce the cups. The initial cost of the expansion will be £750 million. Rena Patel, Chief Executive, is interested in Tom's proposal, but says that to get the go-ahead, the investment will need to be paid back in 3 years and have a net present value of at least 90 million. So often when you get an investment appraisal question, the targets will be laid out for you there, and then some information is given. Now again, you'll probably get the most out of this video if you just take a few minutes to do some calculations and to plan your answer. So here is my plan to answer the question. Now, when I get an investment appraisal question and I know that I need to calculate various things, I would add columns, or at least get a pencil and literally write by the side of the case study a few things in. So to calculate the payback, what I need to do is to calculate both the net cash flow and the cumulative cash flow over the duration of the project, which we've got as 3 years at the moment. All right. Now, the net cash flow is calculated very simply by subtracting the outflows from the inflows. So in this year, the net cash flow was positive 250. All right, I've started off by putting in the initial cost of the investment as well, because that's going to affect our cumulative cash flow. So what's this telling me? This is telling me that I start off by spending minus 750 million, or I spend 750 million. Then in year one, we earn a positive cash flow of 250 million, which takes the value of the project. I pay back 250 million to my initial investment, and we've got a balance overall, a cumulative balance of minus 500. Then I add 350 to that, 500 take away 150. That leaves me with 150 to pay off. And then in year three, I earn a total of 325 million. So that's obviously going to take me into positive, and the venture pays back at some point during year two before year three begins. So I can see at the start of year two, I've got 150 million to pay off. And over the course of this year of production, the net cash flow is 325 million. Well, what do I do with that? I need to work out the monthly cash flow, so I divide 325 by 12. That tells me that I'll be earning 27.8 million per month. I had 150 million pounds to pay off. If I'm earning 27.08 million, I divide per month. I divide 150 by 27.08. That tells me that I'm going to pay back the value of the investment after 2 years and 5.53 months. There's a video on Payback if that was a little bit quick, but hopefully that's reminded you of how to calculate payback. I've also calculated the average rate of return. I didn't need to for this question, but just a little reminder. Okay, now that I've got the cumulative cash flow, over 3 years, this project is returning 175 million to me. Okay, the net cash flow over the 3 years is positive 175. Well, how do I work out the average rate of return? Well, that's over 3 years, so I divide 175.3. It comes out at about 58. Okay, so this project on average earns me 58 million a year. The initial outlay was 750 million, and so if I divide 58 by 750 and multiply that by 100, that gives me an average rate of return of 7.78% per year. Okay, so that's the average rate of return on this project. Finally, so I didn't need to calculate that, but that was just a bit of a revision. But I did need to calculate the net present value. How do I know I needed to calculate that? Because I'm told here that I've got to calculate the net present value because I've got the target, plus I'm given the discount rate here, and AQA have got a record of providing the discount rate for you. So what does the net present value tell us? The net present value tells us the total value of the project in today's money. So we've said it returns 175 million in total, but of course over the 175 million today, 175 million in the future is not going to buy us the same as what 175 million could buy us today. That's because of the effect of inflation, raising prices, and the lost value of interest that we could get from putting the money in the bank. So how do we calculate the net present value? Well, we go back to our net cash flow. So our net cash flow in the first year is minus 750. That's 750 million in today's money, so there's no discount on that. But by next year, this 250 million that we earn next year, because of the effects of inflation, won't be able to buy us as much as 250 million buys us this year. So we need to discount that to make it accurate for today. And to do that, we do 250, we multiply it by the discount rate, which gives us a net present value of 237.5. And we do the same for the other net cash flows, and it gives us, once we've got the discounted net cash flows, we can add them up, and that gives us our present value, our net present value for the project. And you can do minus 750, add these numbers on, and it will give you 82 million. So the net present value of the project is 82 million, which you will quickly see does not meet RINA's criteria. So a good answer to a question on investment appraisal will include both qualitative and quantitative data from the case study to form an argument. So let's see how I've tried to do that. I've got my little plan here that I always do before I start, and then I have written my answer. Now, there's no obvious definition to do here, so I've got straight into answering the question. One of the arguments that could be put forward in favour of Tom's proposal is that his figures suggest the investment will pay back after 2 years and 5.53 months. What have I done here? I've got straight in with a calculation, so the examiner can see that I've calculated accurately the payback figure. this will immediately start collecting me marks, especially when I say that's within the 3-year target specified by RENA. This means the investment might appeal to the company's shareholders and other potential investors who may be concerned about the company's current decline. Okay, I know it's a PLC from the case study, and we also know that they're in a declining market. So what I've done, I've just tried to combine those things. If we tell our investors that we're going to pay back an investment within a few years and then it will become profitable, that might appeal to them. It would also allow the company to benefit from the growth in the market for the high quality fresh coffee provided by the coffee shop chains that appear to be eroding coffee vendors' core business. So this is some qualitative data now. I'm saying that by producing these disposable plastic mugs, cups, they'll be able to benefit from these coffee shop chains, the growth in these coffee shop chains that appear to be eroding their core business. That is, of course, providing they could gain the contracts supplying the large chains. This diversification could be helpful as it appears their current product is in the decline phase of the product life cycle, and therefore finding a growth market would be highly beneficial to coffee vendors. Okay, so I've identified that this would be a diversification for them. I've linked it to the product life cycle, so I've used a business model, and hopefully you can see I've based a chain of argument there on the quantitative data that I've calculated and the qualitative data that I've gained from reading the case study. I've combined that with my own information, and I've come to a conclusion that it would be beneficial to find a growth market for this company. However, there could be some questions regarding the figures that Tom has collected. It is his proposal and he has collected the data. The source of the data is not clear and therefore could be subject to bias. Now this is a very good evaluation point, or a very good argument that you can put forward in an answer. All right? Often there will be some hint in the case study that the data collected is limited in some way or is being collected by somebody who might be biased. So you should look out for that. For example, how has Tom calculated the potential inflows from the coffee cup proposal? Right, we don't have any details about that. In addition to this, even with Tom's figures, the proposal does not meet RENA's target of a net present value of 90 million as it is estimated to be 82 million. So again, I've used the calculation in here, combined it with the target and come to a conclusion. I've used in addition twice at the beginning of 2 sentences, that's not great. But in addition to failing RENA's financial target, there are also serious ethical concerns that should be considered. Coffee cups are coated in plastic and are difficult to recycle. The public is becoming increasingly concerned about the disposal of such materials, and entering this market may damage the ethical brand image that coffee vendors currently enjoy. Therefore, I believe that entering the disposable coffee cup market would not solve the problems being faced by Coffee Vendors Limited. So what have I done? I've tried to combine the quantitative data, again, that I've calculated with the qualitative data, i.e. who's collected this numerical information. Is Tom, he could be biased. Plus, I know that there's issues at the moment around plastic. This business is supposed to be ethical. Combining these factors means that I don't think the disposable coffee cup market is the one for coffee vendors. So in conclusion, I would not recommend that RENA approves Tom's proposal to enter the disposable coffee cup market. First thing I've done, I've answered the question. It's really clear. This is because the venture does not meet the financial targets specified by RENA, and entering the market may damage the company's reputation as the public is becoming increasingly concerned about disposing of plastic-based goods. In this section, I have backed up my conclusion by summarising my previous arguments that I've taken from the case study. So answer, support for my conclusion. However, the company's biggest problem is that they're in a declining market and they need to diversify as a result. Okay, so this is important. The company is declining and they need to do something. Have I got a solution for that? Well, Tom could therefore be directed to investigating the production of reusable coffee containers instead, as this could offer the company a prospect of future growth whilst maintaining their ethical brand image. Okay, so rather than doing the disposable coffee cup ones, is there some future for producing reusable coffee containers instead? So that was my approach to answering this question on investment appraisal, combining the quantitative data with the qualitative data and coming to a very clear conclusion that's balanced and also attempts to solve the company's problems.